Welcome to Money Absolutes, SBI Card Company Analysis and IPO Review. If you are new to the channel, why don't you check Jubilant Foodworks video? Link is provided in upper right corner of the screen. Also, consider to subscribe our channel and ring that bell icon for all notifications. Moving to SBI Cards, I would request you to watch entire video. This is because this firm is riskier than what brokerage firms and media tends to believe. SBI Cards is an NBFC, that is non-deposit taking company which deals in credit card. Basically, it can be loosely categorized under unsecured personal loan segment. Following are the five noteworthy points of credit card market. First, unsecured loan market size was at 5,30,000 crore in FY 2019 and it is expected to grow to rupees 14,40,000 crore by 2024. That is growth of 2.7x in next 5 years. Second, average transaction amount is rupees 3,400 for a credit card, while it is only 1,300 rupees for debit card and rupees 1,700 for UPI. Third, penetration of credit cards in Indian market is at 3% compared to China at 42% and US at 320%. Fourth, has annual interest rates on loan ranging from 24% to 48%. Fifth, four players are dominant in this sector and hold 72% of entire credit card market. HDFC Bank stands at first with 27%, while SBI Cards rank second with 18%. Following are five noteworthy points of SBI Cards. First, SBI owns 74% of the company, while CA Rover holds around 26% of the company. Second, the company was incorporated in year 1998 and has 3,783 personals. Third, credit rating of the company stands at AAA rated by CRISIL and ICRA. Fourth, 12-month revenue ended September 2019 was at 8,622 crores and profit stood at rupees 1,212 crores. Fifth, SBI Cards has partnered with 18 different brand companies. It's highest in the industry. IRCTC is exclusive partner with SBI Cards and no other company. How credit card companies earn money? Main source of income for such companies can be divided into two types: interest income on loans and fee income such as merchant discount rate, that is MDR, and interchange fee. For example, you swipe your SBI credit card at HDFC Bank's POS. SBI card will pay the amount on behalf of you at discount rate of 2.5%. This 2.5% is MDR. That means SBI card will charge 2.5% from the merchant and pay part of the fees to HDFC Bank network platforms such as Visa, MasterCard, RuPay, and pocket the rest. Let's see, if you swipe for 1,000 rupees, SBI will charge 25 rupees from the merchant from whom you are buying. Part of this 25 rupees will be paid to HDFC Bank since the merchant has HDFC Bank's machine. Some part will be paid to MasterCard, let's say, for enabling the transaction, and the rest SBI card will keep it as its fees. Sometimes a customer doesn't pay entire amount due from him in 30 to 45 days. So the amount gets converted into unsecured loan and the customer has to pay 24 to 48% interest rate. If you calculate this interest on monthly basis, it will be somewhere around 2 to 4% payable monthly. Valuation factors. Credit card companies are riskier than banks because they generate unsecured loans without any securities. They charge huge interest rates, but the loan is essentially an unsecured loan. Growth factors depend on how much the company reinvests in the profit and is able to borrow from the market. This is called reinvestment rate. Currently, SBI Cards reinvestment rate is 219% of the profit, which is highly unsustainable. That means SBI Card is reinvesting 100% of the profit and also borrowing 118% of the profits from the market to reinvest. This also explains why the company is growing at breakneck speed. I expect the company to grow at 21% per annum and taper down to 6.25% in next decade. This is because of the factors I mentioned before. Return on capital employed is at 19.87%, which is about average ROCE of what credit card companies earn worldwide. I continue to expect the company to earn average ROCE because of higher competition, slowing economy, and increase in cost of capital in next 36 to 48 months. I expect the company to start paying regular dividends after listing. I assume it will be around 15% of total profits of the company. I expect the company to maintain debt equity ratio of 25% in future. Considering all the factors, I came to the conclusion that the price per share of the company according to discounted cash flow method is 973 rupees. The margin of safety is 30%, which is extremely favorable for me. With expectation of the share to get listed at 750 rupees, I think this share is good for my portfolio and I will bid in market for 1 to 2 lots and not more. Considering everything, this company is quite risky. This company requires high debt for its working capital needs. Any sustained slowdown in the economy will have an extremely negative impact on operations of the company. In bid to grow really fast, there are chances of increase in delinquency ratios and thus hampering the profit of the company. As an investor, you can expect modest gains in short term and medium term. I will keep this stock for next 10 years as the company has all the characteristics of a multi-bagger. I would also say that this is a high risk stock and should be bought as per risk profile of the investor. If I am unable to get this stock in primary market, that is in IPO, I will always buy it in secondary market, but the rate will be always less than rupees 975. As always, I am not SEBI licensed research analyst and cannot express opinion whether to buy or sell the stock. I am just showing how I did my analysis and you should talk to a financial advisor or stockbroker for suitable advice.